welcome to the Property Wealth Podcast. We're so glad you could join us today.
Yeah, it's great to have you here. We're diving into a really important topic, building generational wealth with property.
Absolutely, Mike. So many of us think about what we can leave behind for our kids and grandkids, and real estate is such a powerful tool for that, right?
Exactly. It's not just about buying a property. It's about creating a legacy.
We're going to explore some practical strategies today, like how to identify the right investment opportunities, the importance of cash flow, and even tips on managing your properties effectively.
Plus, we'll touch on some common mistakes to avoid along the way. Because, let's be honest, learning from others' experiences can save us a lot of heartache.
And we want to make sure you feel empowered in your journey, no matter where you're starting from.
So, whether you're a seasoned investor or just thinking about dipping your toes in, there's something here for everyone.
Exactly. So let's get started and unpack some key insights that can help you build that wealth for future generations.
Right. Let's dive in. So, Sarah, it's really interesting when we look at property investment, especially for folks over 40. There's this urgency now. With retirement timelines getting closer, people are really starting to feel that pressure to secure their financial future.
Absolutely, Mike. When you hit that 40 mark, it can feel like time is racing. People start to think, how do I ensure I'm comfortable in retirement? And real estate can be such a powerful tool in that puzzle.
Right, and one of the big reasons it matters now is inflation. It's been a hot topic lately. We've seen prices rise across the board, whether it's groceries or gas. But real estate has this unique ability to hedge against inflation.
Yeah, it's like, as the cost of living goes up, so does property value, right? You're not just sitting there watching your cash lose value. Your investment can appreciate, which is really comforting.
Exactly. I remember this one couple. Let's call them Tom and Lisa. They were in their early 50s, feeling a bit anxious about their savings. They bought a rental property in a growing neighborhood a few years ago. And, the rental income has become a significant part of their retirement plan.
That's a great example. It's like they've not only secured an asset, but they're also creating a stream of income that can help them when they finally retire.
Absolutely. And there's also the emotional side of this. Financial security brings peace of mind. When you own property, you're building something tangible for yourself and your family. It's not just about the numbers. It's about the stability it can provide.
Right. I think many people underestimate how much that emotional security matters. I remember a conversation I had with a listener. They were in their late 40s, and they were worried about leaving something behind for their kids. They felt pressured to build wealth, not just for themselves, but as a legacy.
Yeah, that legacy piece is huge. Property can be passed down, Imagine your children having a home or rental properties that they can manage or live in. It's like they're stepping into a situation where they have a head start.
Exactly. And it's also about the shifts in the market. We've seen so many changes in recent years, but real estate tends to be a stable investment. Unlike stocks, which can fluctuate wildly, property tends to appreciate over time, even if there are bumps along the way.
That's a good point. And I think that stability is especially appealing for those of us over 40. The goal is to build something that will last. And real estate has historically been one of those reliable avenues.
Plus, with the current economic trends, we're seeing more people looking to rent rather than buy. That creates a strong demand for rental properties. If you invest wisely, you can capitalize on that.
Right. There's this shift in lifestyle preferences too. People are valuing flexibility more, and that's leading to an increase in rental demand. I know a family that converted their basement into a rental space. They're not only making extra income, but they've also created a community around them.
That's such a smart move. It's all about being resourceful and thinking outside the box. And really, it's never too late to start investing in property.
Exactly. Sometimes people feel like they've missed the boat, but that's not the case at all. It's about finding the right opportunities that fit your situation.
Yeah, and I think the key is to start small if you need to. You don't have to dive into a huge property right away. Even a modest investment can grow over time, especially if you're strategic about it.
For sure. And I've seen it happen so many times. Someone starts with one property, and before they know it, they have a small portfolio that generates consistent income. It's all about that incremental growth.
Plus, there's something motivating about seeing your investments pay off. It can really change your perspective on money and security, wouldn't you say?
Definitely. It's like a snowball effect. The more you see your investments grow, the more confidence you build. You start thinking bigger and considering more opportunities.
And, with technology now, there are so many resources available. Tools that help you analyze potential properties, forecast returns. It's easier than ever to make informed decisions.
Yes, and having that knowledge can empower people over 40 to take control of their financial future. They don't have to feel lost or overwhelmed. They can approach this with a clear plan.
Right. And I think that's a big part of what we're trying to convey. Property investment isn't just for the young or the wealthy. It's accessible and can be a game changer for anyone willing to learn.
Exactly, and the journey can be really rewarding. You're not just building wealth, you're shaping your future and creating options for yourself and your loved ones.
So true. And as we move deeper into this topic, we'll explore some core strategies for building generational wealth through property. It's all about making informed decisions and taking those next steps.
So let's dive into some core strategies for building that generational wealth through property.
Yeah, I think starting with some straightforward rules of thumb can really help listeners get their heads around it.
Absolutely. One of the most popular ones is the 1% rule.
Right, the 1% rule. Can you break that down for us a bit?
Sure. So the 1% rule states that the monthly rent you can charge for a property should ideally be at least 1% of the purchase price. For example, if you buy a property for $200,000, you should aim to charge about $2,000 a month in rent.
That makes sense. So if the rent is lower than that, it might not be a good investment?
Exactly. If you're only getting, say, $1,500 a month, you might want to reconsider. It could mean the property will take longer to pay itself off or won't generate as much income.
And it's important to factor in expenses, right? Like maintenance, property taxes.
Yes, definitely. That leads us into the 50% rule.
Oh, I like that one too. What's the 50% rule about?
It's pretty straightforward. When you're calculating potential cash flow, assume that about 50% of your rental income will go towards expenses. So using the earlier example, if you're bringing in $2,000 a month, you'd estimate about $1,000 for expenses.
So you'd be left with $1,000 a month as your net income?
Exactly. It gives you a clearer picture of what you'll actually make.
And that's crucial for planning your financial future, especially when you're investing for the long term.
Definitely. Now let's talk about cap rates. They're really useful for evaluating the potential profitability of a property.
I've heard of cap rates, but how do they work in practice?
The cap rate is calculated by taking the net operating income, NOI, of a property and dividing it by the property's purchase price.
So if you have a property that makes $12,000 a year in net income and you bought it for $200,000, what's the cap rate?
You'd divide $12,000 by $200,000, which gives you a cap rate of 6%.
Okay, so what does that number tell us?
A higher cap rate generally indicates a better return on investment. For example, a cap rate of 6% is considered good, while a cap rate below 4% might signal a less favorable investment.
Got it. And this can help you compare different properties, right?
Exactly. It's a quick way to gauge potential profitability without diving too deep into the numbers at first.
Speaking of numbers, what about deal evaluation checklists?
Great point. Having a checklist can really streamline your decision-making process.
What kind of things should be on that checklist?
Well, first, you'd want to confirm the property's purchase price and potential rental income, of course. Then, check the location. Is it in a desirable area?
Right, location is everything in real estate.
Yes. Then, look at property condition, what repairs or renovations might be needed, and the overall market trends.
So understanding whether property values are rising or falling is key.
Exactly. And don't forget about financing options.
Ah, yes. What should investors consider there?
Well, traditional mortgages are a common choice, but there are also options like FHA loans for those who might qualify.
And for those with more experience, maybe even commercial loans or private money lenders?
Yes, those can be viable options too. It really depends on your financial situation and investment goals.
And how do you decide which property type to invest in?
That often boils down to your risk tolerance and investment strategy.
Like, would you recommend starting with single-family homes before moving on to multifamily or commercial properties?
That's a solid approach. Single-family homes tend to be less risky, especially for new investors.
And they can be easier to manage.
Exactly. But once you're comfortable, branching out into multifamily properties can offer higher returns.
So it's all about scaling up as you gain more experience?
Yes, and also diversifying your portfolio. It can help spread risk.
And what about markets? How do you choose where to invest?
You want to look for markets with strong job growth, good rental demand, and affordable housing prices.
So places where people are moving to instead of away from?
Yes, that's a great way to think about it. Also, research local laws and regulations, as they can impact your investment significantly.
Definitely. You wouldn't want to get caught off guard by unexpected legislation.
Right. And remember to keep an eye on the local economy as well.
So it sounds like there are a lot of factors to consider, but they all lead towards making informed decisions.
Exactly. And that's what we want to aim for.
Now, before we wrap up this section, what are some common pitfalls that new investors should watch out for?
There are quite a few. But let's save that for the next part. It's important to recognize those challenges before jumping in.
For sure. It'll be crucial for our listeners to understand those dangers.
Definitely. Let's dig into that next. You know, one of the biggest pitfalls I see, especially with new investors, is over-leveraging. It's tempting, right? You see a property that looks great, and you think, why not borrow a bit more? But that can backfire.
Absolutely. I mean, it's easy to get caught up in the excitement of a potential deal. Can you share a real example of someone who went down that road?
Sure, I remember a client. Let's call him Tom. Tom found this charming duplex in a great neighborhood. He was so excited that he stretched his budget and took on more debt than he could comfortably handle. Initially, it seemed like a good move, but then the market shifted. He faced unexpected maintenance costs, and suddenly, he was underwater on his mortgage.
Wow, that sounds stressful. What could he have done differently?
Well, he could have started with a more conservative approach, like really focusing on cash flow rather than just the potential appreciation. If he'd made sure his rental income covered his mortgage and expenses, he might have weathered that storm better.
That makes a lot of sense. So cash flow is key, right?
Exactly. But here's another common mistake: ignoring cash flow altogether. I've seen investors so focused on the property's future value that they overlook what's happening right now.
Right, like if the property isn't generating income in the short term, what's the point?
Exactly. One investor I worked with, let's call her Lisa. She bought a single-family home thinking it would appreciate quickly, but she didn't calculate expenses, like property management fees and maintenance.
And that must have hurt her cash flow.
It did. She ended up in the red because her expenses were higher than anticipated. If she'd done her homework and understood her cash flow better, she might have chosen a different property, or at least one that had better income potential.
So it sounds like doing thorough research is essential.
Definitely. And speaking of research, another pitfall is relying too much on timing the market. It's a gamble.
Oh yeah, the classic buy low, sell high strategy.
Right. I had another client. Let's call him Dave. He was convinced that prices were going to drop, so he held off on purchasing for months. Well, the market didn't drop, and he missed out on a fantastic deal.
That's frustrating.
It is. Instead of trying to time the market, it's often better to focus on finding a good property that meets your investment goals.
And what about hidden costs?
Hidden costs can really sneak up on you. I remember a client, let's call her Rachel, who bought a property and didn't account for things like closing costs, insurance, and property taxes.
Wow, those can add up quickly.
Exactly. Rachel thought she was getting a great deal, but when all those costs came in, her budget was stretched thin. She had to make some tough choices.
So it's crucial to have a complete picture of the financials before diving in.
Yes, and being aware of potential red flags early on can save you a lot of headaches down the line.
What are some of those red flags to look for?
Well, for starters, if a property has been on the market for a long time, that can be a warning sign. It could indicate that there's something wrong with it, or perhaps it's overpriced.
That's a good point.
Also, if the sellers seem desperate to close quickly, that can raise some eyebrows. You want to ask yourself, why?
Right, it's like, what are they hiding?
Exactly. And then there are things like tenant history. If a property has a history of bad tenants or high turnover, that's definitely a flag.
Oh, that's definitely something to consider.
Yeah, I had a client, let's call him Steve, who ignored tenant history. He bought a property that had a revolving door of tenants. It turned out to be a nightmare.
So what happened?
Well, he ended up spending more time and money trying to find reliable tenants than he anticipated. He could have avoided that if he'd done a bit more digging into the tenant history before purchasing.
It's all about doing your homework, isn't it?
Absolutely. And if you do find yourself in a tricky situation, it's not the end of the world. There are ways to recover or pivot.
Like what?
Well, if you've over-leveraged, you can look at refinancing options or even selling one of your properties to reduce debt.
That's a solid plan.
And if you're struggling with cash flow, consider raising rents or finding ways to reduce expenses.
Makes sense.
And remember, it's all about learning from those experiences. The real estate market is always evolving, and so should you as an investor.
Yeah, those lessons can be invaluable for future investments.
Exactly. It's not about avoiding mistakes entirely, but rather managing them effectively and making informed decisions moving forward.
That's such a positive way to look at it.
Totally. And, as we wrap up this discussion, I think it's important to remember that building generational wealth takes time, patience, and a willingness to learn.
Absolutely. It's all about being proactive and informed along the way.
Right. So keep your eyes open for those red flags, stay grounded in your research, and don't shy away from asking for help if you need it.
Great advice, Mike. I think listeners will find that really encouraging as they navigate their own real estate journeys.
I hope so. Each step taken is a step towards building that wealth, and every mistake is just another lesson learned.
Well said. Now, what's next for our listeners as they embark on this journey?
Let's talk about actionable steps they can take to move forward confidently. Sarah, when it comes to building generational wealth with property, the best part is that you don't have to jump in all at once. You can start small and build your way up.
Absolutely, Mike. It's all about taking those first steps, right? So what are some immediate actions folks can take today to get started?
Well, a great first step is to analyze properties. I always suggest people start with just one deal a week. It doesn't have to be a full-blown analysis, just getting familiar with the numbers. Like, what's the asking price? What are rental rates in the area?
Yeah, and using tools like Zillow can really help with that. You can see current listings, price history, and even neighborhood trends. It's a fantastic way to get your feet wet.
Exactly. And then there's the Bigger Pockets calculator. It's a fantastic tool for analyzing potential investments. It walks you through cash flow calculations, ROI, and all that good stuff.
I love that one. And if you're looking for a more straightforward way to compare properties, DealCheck is another app that's super user-friendly. It breaks down everything for you and helps you visualize potential returns.
Right. And if you're also thinking about rental properties, Rentometer is great for checking rental rates in specific areas. You can quickly see if a property is priced right for what it could potentially bring in.
And don't forget about your local MLS access. If you have a realtor or if you're part of a real estate investing group, they might provide that access. It gives you a detailed look at what's available and what has sold recently, which is invaluable.
Yes, definitely. And while we're talking about resources, I think it's also important to mention some books and podcasts that can really help. For books, Rich Dad, Poor Dad by Robert Kiyosaki is a classic. It really shifts your mindset about money and investing.
That's such a great recommendation. And for podcasts, Bigger Pockets Podcast is fantastic. They share real-life experiences and strategies from seasoned investors. It's super relatable and packed with insights.
For sure. And speaking of habits, I recommend joining a local real estate meetup group. Connecting with others can provide support, motivation, and even potential partnerships.
That's a great tip. Networking can open so many doors. And even just attending one meeting a month can help you stay engaged and informed.
Exactly. It's all about building that community around you. Plus, you'll hear firsthand about local market trends and investment opportunities.
And remember, starting where you are is key. You don't need to know everything before you dive in. Just start analyzing those deals, connect with others, and gradually build your knowledge.
Right. And it's also a good idea to set some goals. Maybe aim for a certain number of deals to analyze each month, or a specific number of meetups to attend. Keeping track of your progress can really motivate you.
Yes, and you can use apps like Trello or Notion to manage those goals and keep everything organized. It's a great way to visualize your progress and stay accountable.
Oh, absolutely. And don't underestimate the power of keeping a journal. Documenting your thoughts, what you learn, and what you want to achieve can be incredibly motivating.
It's like having your own personal roadmap. And you can always look back and see how far you've come.
Exactly. And as you get more comfortable, you can start exploring more advanced strategies like house hacking or even investing in commercial properties.
Right. It's all a journey. And the beauty of real estate is that there are so many paths you can take. Just take it step by step and allow yourself to grow.
Well said, Sarah. Remember, it's not about rushing. It's about consistent, informed actions.
And with these tools in your pocket, you're ready to move forward. Let's recap what we've covered today.
So as we wrap up this episode on building generational wealth with property, let's recap some key takeaways.
Absolutely. First off, we talked about how starting early, even if you're over 40, can really set you up for that long-term wealth. It's never too late.
Right, and then there's the importance of diversifying your investments. You don't want all your eggs in one basket, you know? Different types of properties can really help cushion against market fluctuations.
And don't forget the power of leveraging. Using other people's money can accelerate your growth. It's a smart way to expand your portfolio without needing to have all the cash up front.
Exactly, and we also discussed the significance of understanding your local market. Finding out what areas are on the rise can make a huge difference in your investment returns.
For sure, Mike. And lastly, we touched on the emotional aspect of investing in property. It's not just about numbers. It's about creating a legacy for your family and future generations.
Building wealth through real estate can feel daunting, but remember, it's a journey. Start small, stay informed, and be patient. The rewards can be life-changing.
Yeah, and if you found today's conversation insightful, please like this video, subscribe to the channel, and drop a comment below with your biggest takeaway or any questions you might have.
And if you know someone over 40 who's considering investing in property, share this episode with them. They might find it really helpful.
Next time, we'll dive into a topic that's super important. Divorce and real estate, protecting your assets. It's a crucial conversation that many people face.
It really is. So make sure to tune in for that.
Thanks for joining us today. We hope you're feeling inspired to take the next step in your property journey.
Yeah. Take care, everyone, and happy investing.